Michael Babikian is currently the CEO of First Financial Resources, also known as FFR, which is an elite group of financial, investment, and life insurance advisors in the country. I also sit on the board of FFR currently. Michael has a rich background in the financial industry, as he is the former president and CEO of Legacy Shield, as well as the former president and CEO of Transamerica. In this podcast recording, I interviewed Michael about his thoughts on some of these overly aggressive premium financing programs that tell the client that they don't have to pay anything out of pocket into the program and that they just have to post collateral. These ridiculous programs are essentially touting free insurance, and yet they don't disclose to the client the amount of risk that they incur by doing this. And in life, as you probably know, you rarely ever get something for nothing. The client is asking me, well, why can't I just do the free thing like what the other firm is showing? I said, look, I can do the free thing. It's not like I don't have lenders. I got 19 lenders. I got more lenders that will do this deal than you can shake a stick at. You have to ask yourself, why am I recommending that you not do this? Because you're telling me you'll buy this right now from me if I do this design of free insurance.
Darren, you and I have talked about this, and I'll even mention it. And we're going to hold ourselves up to a higher standard than what the law would afford. Because there's a lot of people that are like, well, that's not illegal. Is that the standard that as professionals that we want to hold? Just because it's legal, that's not the standard. Or just because it's legal and you can do it doesn't mean you should. It's not what you can obtain. It's what you can maintain.
It's not what you can obtain. It's what you can maintain.
So I think this is great. Let's jump into it.
So, we wanted to get together today and talk about this whole free insurance proposition, right? Where in premium financing, there are so many, as we talked about before, bad actors in the space, right? Where the client is led to believe that everything is going to work out perfectly, and don't worry about interest rates increases. Don't worry about policy performance being less than stellar. You're going to have positive arbitrage into perpetuity, and you don't have to put any money in, and you're going to get this, tens of millions of dollars of insurance for nothing out of pocket. And I've been so adamantly against that proposition from the very beginning. And this is back when rates were extremely low. I mean, 4 years ago, I was getting money from U.S. Bank for 1.35%. This is when SOFR was like 5 bips, right? Almost free money. And when rates increased from sub 2% up to over 7% a couple of years ago, you had a lot of premium financing programs blow up that were reliant on that massive arbitrage. And we've always done things very differently and been very conservative and very transparent with clients. And we always talk about the risk. So that kind of frames up what I wanted to talk to you about today. As you've seen premium financing programs blow up and lawsuits and all the evils that come with premium financing, as it pertains to this free insurance proposition, what do you see or have you seen as being kind of the biggest factors in a premium financing program blowing up?
Yeah, Darren, I appreciate that. I've been involved in premium financing even before I started at a carrier. I think even before I got into the industry. In fact, it was one of the things that got me into the industry. I was at a multifamily office, got involved in premium financing in the late 90s after graduate school, and have seen the good, bad, and ugly around any kind of external leverage that gets placed onto a policy. And I would say it this way. It's not what you can obtain, it's what you can maintain. And whether it's free insurance or inappropriate leverage or inappropriate assumptions, it sets up the client on a course of something that is difficult to maintain on a longer term basis. And so that's really what I think is the issue that sets up a client on a course that has a collision down the road. And again, some of that comes up with a producer or a financial professional that doesn't maintain it properly. So even if you set it up perfectly from the outset, if it doesn't get maintained properly, it's almost the same as whatever free insurance, the underlying assumptions that went into it that were not maintainable on a longer term basis. So I think that's the underlying issue is this set up for proper maintenance for where we find that client day and the underlying assumptions of what we're going into from a longer term perspective. And any kind of external leverage, premium financing, or the underlying assumptions in a sophisticated life insurance transaction is going to require long term maintenance.
Yeah, I love that wordplay there. Easy to obtain, difficult to maintain. Kind of like marriage, right? It's relatively easy to get someone to say yes, I'll marry you, but maintaining that relationship long term, that takes a lot of work. It's got to be done, properly. A lot of care needs to go into that.
Yeah, Darren, it's well said. It's almost any long-term relationship we get into, and even outside of relationships, it's the things that we get involved in. You and I are both car guys. We like a lot of things that have precision around it. Both you and I we've talked about that aspect of things, whether it's watches or cars or all sorts of things that have a precision element to it. And you and I also don't want to have a very high maintenance lifestyle. And so you could go out and buy a Ferrari tomorrow, no problem. Do you want to maintain a Ferrari? And that's a very different proposition than obtaining it. Obtaining that car is a lot easier than maintaining that car over a 20-year time frame. And that's really what all of this boils down to as well. Getting into premium financing these days is likely easier than it is to be able to maintain it over a longer period of time. Learning and figuring out what the exit strategies are before you get into it, and then dealing with the environmental factors around it. And Darren, I'll take a 30-second tangent here, and I'll just tell you, a number of years ago, I did a focus group where I had actual clients sitting in a room, and I was outside of the room observing this. And one of the things that really came about that was really interesting to me was this. We had a client that was a former NASA mission control operator. And he said, one of the things that I worry about, this is general financial services, by the way. And he said, one of the things that we do as mission control operators is that we spend months and years preparing for a launch. And we launch, and single digit percentages are what the rocket stays on track on any launch basis. So it's like 2% of rockets that launch will actually stay on course. Mission control keeps that rocket back on track and on course from environmental factors, headwinds, side winds, all sorts of things that happen. We have the same thing with life insurance. And in fact, what he said is, my financial existence, I don't have mission control. I don't have somebody that is putting the rocket and the launch back on course on a daily, weekly, monthly, annual basis. And that's what all of this boils down to. And it was a real aha moment for me in the maintenance aspect of the things that we launch and put into place. And all sorts of unexpected things happen from a environmental perspective of anything that we put into place. You do some very sophisticated planning, and the real art and science of what you do is after you put it into effect. What happens the next day? What happens if the stock market changes overnight? We live in an incredibly volatile world, and I don't think that's going to change anytime soon. And it's really the maintenance aspect of what you're going to do going forward. And that focus group really stuck with me. It was a long time ago, but that's one thing that I've just seen that has been the biggest difference maker in what you put into place.
Yeah. Well, again, the whole idea of a free insurance program, cashless insurance transaction. What else do they call it out there? Some sort of legacy capital reserve play. All these different fancy kind of made up terms are all basically saying, don't make your interest payment. Just roll all the interest, just capitalize it back into the loan. And that will work if the policy performance every year is 2 to 3% greater than the borrowing rate, right? If I could borrow it at a rate of 4%, and I could go to Vegas and keep putting it all on black and always win, well, yeah, I'd borrow a million gajillion dollars and bet it on black. But the challenge is the risk. And then in premium financing, what happens if the borrowing rate increases just at 1 percentage point? God forbid 2 or 3 percentage points. So as most of the people that are going to be watching this know, insurance carriers can only illustrate a certain rate of return if they're going to, let's say they're going to illustrate an IUL as an example, right? Usually illustrating about 6.5% or so. Well, it doesn't take a rocket scientist to figure out that if you show a borrowing rate of 2 points less, say 4.5%, and you're earning 6.5% in the policy, well, you wouldn't have to service the interest because you're making 2% on that loan every single year into perpetuity. And it's kind of like when I look at like the mortgage lending space, and you go back to 2005, 2006, where everyone was doing like negative amortization mortgage loans or variable mortgage loans. That all would have worked great if 2008 didn't happen. But in life, sometimes crap happens, and 2008 was a pretty big, crap, and lots of people got ruined, financially ruined. And so I look at the premium financing space. Just a couple of years ago, something very similar happened, right? We went from sub 2% borrowing rates to over 7, and all of a sudden, you can get away with accruing 2% debt, but if you're accruing 7% debt, proposition changes dramatically. It's the client's expectation management, which is largely due to the lack of client education up front, the lack of transparency from the advisor to the client in terms of how this transaction actually works over time. Perfect example of this. I got into my current home almost 20 years ago, and I used a variable mortgage loan, and everyone thought I was crazy. Well, when rates were really low, everyone thought I was a genius. And when rates went back up, everyone thought I was an idiot, right? So over time, that has actually worked out to my advantage compared to had I done a 30-year fixed loan, 20 years ago. Fortunately, I've been in a situation where I could stomach and pay the larger mortgage payment when rates are higher. And then I took advantage of, from a cash flow standpoint and a opportunity cost standpoint, paying much lower mortgage payment when rates were lower. But over time, I've actually won in that proposition. But I understood what I was getting into from the very beginning, and I was risk tolerant enough and in a cash flow positive financial situation where I could stomach that. Where I've seen these premium financing cases go south is when all of a sudden the client is expected to pay either an interest payment that is substantially more than they were bargaining for, and now that gives them some heartburn. Or, and more commonly probably, when they were proposed this so-called free insurance thing, cashless transaction, all of a sudden, they don't have to pay anything in, but they've got to post a ton more of collateral. So if they were planning on posting let's say they're planning on posting a maximum of, say, $3 million in collateral, but then they get a $5 million collateral call. That hurts. It hurts even more if a client doesn't have the extra $2 million in liquid to post as collateral. But even if they do, even if they're very, very liquid and cash rich, it's just the expectation that wasn't met. And the example I used yesterday when I was on a call with an advisor and their client, I said, if I go to park in a parking lot and I think it's $5 and I get charged $20, $15 isn't going to make a difference in my checking account, right? It's $15, but it's angering because I thought it was only going to be $5 and now it's $20, right? It's 4 times more. So I think that if the client understands upfront what the risks are, and they're a suitable client for this type of strategy, even if the world doesn't work out perfectly, it's okay. I was asked on a panel at a National Life Group symposium last week in Dallas. They asked me what was the best premium financing case I've ever done, and we've got a client. This year was their 5th year. And last year they renewed, and the rate was substantially higher than what we had originally bargained for. The rate going into it, again, was 1.35%. Okay, last year they renewed it north of 7%. So I'm anticipating the client at the renewal review being a little irritated. So we get on the Zoom call. He starts off and he says, I'm not happy about the rate, obviously, because I'm very aware that interest rates across the board have gone up. He goes, here's the good news. The good news is that I'm extremely liquid, so I was the right client to do this in the first place. He says, the other good news is you talked to me about what might happen if the rates go up. And nobody thought 5 years ago that the rates would, more than triple.
Sure.
But I talked to the client about that. And the client said, I can pay it. So we talked about the whole proposition in premium financing. It's an LTV proposition, right? A loan to value proposition. So if you have to put more interest in as opposed to accruing that interest, it's not a cost per se. It's dollars in versus dollars out. And the dollars in versus dollars out still work to his advantage, even at a 7.5% borrowing rate, right? So we started ratcheting it up. I said, hypothetically, if you had to pay 8%, dollars in, dollars out, is that still a good proposition for you? He said, yeah. I go, what about 9%? What about 10%? What about 12%? 12% borrowing rates. Who's going to premium finance for 12%? But for that particular client, it made sense because he's keeping his powder dry and he's making far more than 12% in all of his other investments and business endeavors. So I say all that to say, if this is explained properly to the client, if it's the right client, the client that should actually be using the leverage that premium financing allows, it doesn't matter if the rates go up substantially because over time, it all evens out, right? You're going to have high interest rates, low interest rates. You're going to have big policy performance, you're hitting caps, and you're going to get some zeros. Over time, historically, as we very critically analyze, you do have positive arbitrage over time, but you're going to have negative arbitrage in this year or that year or whatever. And if we show that to the client up front, and that happens, they don't freak out if they're upside down a couple of years. How do you feel about it? An advisor comes to you and says, I have a client, they're worth $50, $100 million. They're not very liquid. Let's say they're super real estate heavy or something like that. And they need, $30, $40 million of life insurance for estate and tax planning purposes. But they don't have a lot of liquid and they don't want to pay very much. What would you, I know what I would tell them, but what would you tell them in that type of scenario?
Yeah, that might not be the right client. Again,
that's what I would say.
That's the issue is when you set up those expectations from the beginning. I was with you until you said they don't want to pay very much. Right. It was great, Darren, until you said they don't want to pay very much. That just sets up that client on a pathway. And today you might be able to, or in a lower interest rate environment, or given some more aggressive assumptions, you could absolutely set up a scenario where that works today. Does that work long term? Is that maintainable longer term? Well, all sorts of things need to happen for that scenario to play out where they're leveraging and they don't have to pay very much. You're probably going to have to assume a world in which interest rates really start scaling down over the long duration. And that may be the case, but is that always going to be the case? And what's the probability of that being the case? And are you going to be able to properly manage that client's expectations over the long haul? And it's like the mission control aspect of what we talked about. 6 years down the road, 7 years down the road, if interest rates haven't done what you planned in that strategy, well, that client's going to be pretty darn upset about things. And I realize that clients oftentimes have all sorts of selective memory around what they remember from a conversation. And you, Darren, I know your process really well and how you do things and what you record and how you maintain that client relationship from a longer term perspective. And that's why if a lender or funding source comes to us and says, we're thinking about setting up a new premium finance program, you know my approach. You need to talk to someone like Darren to make sure that I'd rather plug that into your availability rather than set up something, because all of the experience that you've gained over the years, I'd rather have that than a unique funding source out there that doesn't have the decades of experience of knowing what's going to work and what's not going to work.
Yeah. Go back 2.5 years ago, I get an advisor reach out to me that knows I do premium financing. And he says, I've got a premium financing case in force right now and I'm in trouble. I'm pretty sure the client's going to sue me. Would you take a look at the case and see if you could, give me some guidance? So I said, send me what you got. He sends it over. I look at the proposition. I look at the original illustration and proposal. And I said, oh man, I said, lawyer up quick and settle as fast as you can, because if this goes all the way, you're going to get cooked. I mean, the optics are not good for you on this. And that was really the only interaction we had, all via email. 2.5 years later, which was earlier this year, opposing counsel in that lawsuit reaches out to me and subpoenas all email communication between me and this advisor, even though I had nothing to do with the case, right? I didn't finance the case. And then I get called into deposition. I'm like, deposition? Why? How am I getting called into deposition? I wasn't even on this case. I was just reviewing it after the fact, trying to help this poor advisor that was about to get sued. So scheduled the deposition date. A videographer shows up at my house, and there are about a dozen attorneys on a Zoom. It's 4 hours of deposition on a case I have nothing to do with.
Yeah.
I thought to myself as I was going through this, what a waste of my time. I can't believe I just gave away 4 hours of my life for something I had no involvement in whatsoever. But after it was over, I realized this was one of the most valuable 4 hour blocks I've ever spent, because I got to personally experience every little thing that opposing counsel would pick apart of a premium financing design. And it made me even more confident at the very end, because I realized every element they picked apart, I disclose and communicate all of those risks in every single premium financing case we do with every single client. One of the most valuable experiences I could have had. And I wish I could have recorded it because it was a masterclass in things that can go wrong in a premium financing case if these issues are not disclosed to a client up front.
Yeah, you and I have talked about that situation, and I could tell you, I've done a lot of depositions. I've done some expert witness work, not my favorite, but there were particular situations. But I've done a lot of depositions over the years, not because I wanted to, but because I had to. And it is absolutely a learning experience. I've done a bunch of graduate work. All of it was Socratic, in the sense that it was all case method and Socratic. And you learn a lot from other people's cases. You learn a lot from other people's situations and what can and can't go wrong. And those 4 hours, I've had depositions that have gone 3 days, literally 3 days. And you learn on a nitpick basis everything that can and can't go wrong, and all of the things from a perspective of the way plaintiff's counsel is going to look at it. And building that in to what you do. You and I have talked about this. When I first started out in this industry, and I started creating agreements for particular things, particular transactions, I actually would hire in contract litigation counsel. So civil attorneys, to be able to look over the agreement and tell me every place that they would litigate over, so that I could shore up the agreement against that. Right. And basically make my agreements. And what you're talking about is the same exact thing, is what you learned and what you shored up, what you do is the perspective of what a plaintiff's counsel is going to look at as weaknesses in every bit of the transaction. And we all ought to learn from that, not because we're just trying to avoid litigation, but it's all the things that can go wrong that, again, probabilities over a longer cycle have a higher probability of going wrong, and how you plan around and against that.
Yeah. Yeah, I did something very similar in we call it the client memorandum of understanding, which is a document that's attached to our proposal. Every client initials and signs. And one of the most recent modifications we made to it was we added a section called the client attestation section. Mm-hmm. So not only before that section does it list all the variable collateral, variable interest rates, policy performance, all the different things. It's not almost redundant. It is definitely redundant, but it goes over each one of those issues and literally says, I attest to the fact that I have been made aware of fill in the blank, right? That the variable interest rates could go up. And then if that happens, then I would have to pay a higher interest payment, and then I might have to pay more or post more collateral if the policy performance is less than what was illustrated. All of those things, initial, and then of course everyone signs at the very bottom. I even have a release of parties section where it says I release the liability of the so-called released parties, which is me and my firm and all that. If I make any changes to the original plan, which I think is a great segue into the very infamous Cal Bush lawsuit that everyone in the industry has been made aware of. And um, as I look at the issues in that case, and I want to be respectful of the deceased. I just don't like talking about legal issues of someone that isn't here to defend themselves anymore. So I want to be respectful of that. But prior to Kyle Busch passing, as I was kind of watching the play-by-play of that lawsuit as it unfolded, one of the issues was that Kyle Busch or his estate did not pay the full premium. I think they paid like half of the annual premium. And it's like, well, what do you think is going to happen to the cash value and the long-term sustainability of a life insurance policy if you don't make your full premium payment? That's like not making your full mortgage payment. What do you think is going to happen, over time? And so things like that, if the client makes a decision and goes off of the original plan, I don't think the advisor, or in this case, the premium financing intermediary, right, my firm, should be responsible whatsoever if the client goes off the plan. That's crazy. So those types of linguistic elements of our client memorandum of understanding, I think, are certainly not 100% bulletproof, but certainly protect us more than not having those elements in that proposal, right?
Yeah. Darren, I'll make a comment about the Kyle Busch situation. I know it's top of mind for a lot of people in the industry right now. First and foremost, I'll just mention you have taught me and hopefully a lot of our industry about we talk about death so clinically in our industry. And you've taught me a lot of the language and the approach around grief and how to deal with people that are grieving. So first and foremost, it is an incredibly sad situation when you have a person that young that passes away, leaves a family and everyone else around them to deal with an incredibly difficult situation. So, and I know a lot of us don't say it, but we mean it. But I just want to say that first and foremost. You've got someone that young that passes away. Both my parents passed away really young. I can just tell you, just from that personal experience, it's incredibly devastating. And so that I just want to acknowledge that aspect first. The second aspect of what they put into place, what they were trying to unravel, what got settled in February, and other insurance had been put into place because those policies had lapsed a while back. I'm glad that there was other insurance. There's also this whole discussion around the right type of insurance. The right type of insurance is the one that pays a death benefit when the unthinkable happens.
Right.
I just want to be incredibly clear about that aspect as well. I've been fortunate or had some unfortunate circumstances in delivering a lot of death benefit checks, and I've never heard a widow or widower or family member that has received a death benefit check that asked what type of policy it was on. So that all of that is incredibly important. And then beyond that, you're absolutely right. Did everyone understand and was all of this maintained properly? And obviously there was a lot of confusion around it. There was a lot of unmet expectations around it as well. And then we also have professionals that get their names dragged through the mud in our industry. I, like you, love this industry. In fact, you and I talked about this. The purpose of even doing any of this is for the love of our industry and what this amazing solution can do for families and individuals and businesses. And I don't want that to be lost in all of this. But that is in the highlight reel from a media perspective. And again, we all ought to think through when these situations get put into place. What's a client's expectations? Did they actually expect that I have to pay those premiums, or is it flexible? It's not like a mortgage payment. It's kind of an optional, it's suggested. And I don't know the circumstance there. Most of us will never know that. But what we can know is the situation with our particular client, our particular scenario. And so what you're bringing up is exactly right. If if they understood that they needed to make those payments and they didn't make those payments, of course it's going to fall apart and how could you possibly expect to have that? It's the same thing that we were talking about the mortgage that you brought up. If you don't make your mortgage payments on a fixed mortgage, how could you possibly expect that to work from a longer term perspective?
Yeah. It's optional to put gas in your gas tank in your car.
Yeah.
But
Yeah.
it doesn't mean you're going to make it to your final destination. I mean,
That's
come
exactly.
on. Gotta be realistic here.
No, that's exactly right, and that's a great analogy as well. It's you can plan the trip across the country, and you can believe that putting gas in the car is optional. At some point, it's going to catch up with you.
Yeah. I mean, I've even seen premium financing cases because sometimes what will happen is my proposition is being measured up against a competitor's proposition, right? It doesn't happen a lot, but it happens from time to time. And some of these designs I've seen, the policy is not max funded. So on an illustration, they might show a higher death benefit for the same amount of premium that's going into my plan. And if everything works out perfectly and there's just enough cash value in that policy to sustain it all the way to the end, then it looks like the other side has a better proposition. But that's a very novice way to look at it. And the client is a novice when it comes to understanding how these products actually work. As we wrap up here, could you kind of share with us a little bit about the vision you have with this new organization you're in the process of building, how this came to kind of into fruition, and what your perspective is on how this is really going to help the industry as a whole? And then you said something I thought that was really, really great about how you and we love this industry. I think you and I, the reason we love this industry and the reason we want to protect this industry is ultimately the love isn't really just the industry, it's the trickle down love, because
Right.
the love ends up with protecting families. We're
That's right.
talking about loving people, right?
That's right.
That's what we really love about the work that we do. And so I applaud you and respect and admire this kind of additional direction that you're headed with this new organization. But yeah, could you share with us a little bit about that?
Yeah, I'm humbled by that, Darren. You know that, and you're along for the journey. You're along with, and I really appreciate your leadership in that and stepping up, even in very, very difficult personal times. So I just want to tell you personally how much that means to me. You're absolutely right. All of this for me comes back to impact. And protecting individuals and families and their businesses and the impact that has on the people around them. So all of that comes back to that. And our industry does some amazing things. If you look at macro trends over the last number of decades, 50 years, the macro trend has been to take risk, all sorts of risk, to take risk and shift it from larger organizations, governmental bodies, institutions to individuals and people that are not even fully understanding what risks that they're taking on in life. And our industry allows people to shift that risk back to where it can be managed and maintained more properly than the individual. Our industry is the only place that you can do that. We offer underlying guarantees, and that's what I love about our industry. There is an absence from a trade association perspective in our industry to raise the awareness, the professionalism, the profession of our industry to do things above what the legal standard is, the minimum legal standard. We have a lot of trade associations that work in advocacy and certain other things, but not necessarily to raise training and some other things that our industry can do and to make things better for individuals, families, and businesses. So I'll throw out one small example. I talked to chief underwriters at carriers. We would love to be able to get a universal HIPAA form. Where would you park that today? And we created MIB decades and decades ago at on an industry level. It's that type of service that we need to be able to do. And whether it's something as basic as a universal HIPAA form or training for people that have been in the industry for a long time or the next generation of advisors that are coming into the industry. So we're forming the Financial Professionals Association, or formed. It's out there, and so we'll start getting this out there. And I really appreciate you being involved in getting this going, Darren. It's a labor of love from that perspective. Again, to have the kind of impact on all of the advisors. Ultimately, I think the hero in all of this is an individual along with an advisor that works together to be able to provide financial sustainability and a safety net for the people that they love around them. That's the hero in all of this for me, is that advisor and a client and that relationship on a long-term basis. So that's who it's ultimately for.
Awesome. Well, thanks so much for joining us this morning. Such a wealth of information, and you're really you're one of the few beacons in this industry that I look to as to kind of carry the torch and be our guiding light. So appreciate everything you do. Appreciate you as a friend.
Likewise, Darren, appreciate you as a friend. Most importantly, thank you again for having me.
All right, buddy.